Yesterday was the day markets had been dreading. CPI came in hotter than expected. Qualcomm had its worst session since 2020. The chip sector collapsed. Oil crossed back above 107. And GameStop made a move so audacious that analysts compared it to the worst business deal in history. I am breaking all of it down right now. The April CPI report landed at 8:30 yesterday morning. Headline inflation came in at 3.8%, year over year matching expectations, but above the 3.7 Dow Jones consensus. But the headline was not the problem. Core CPI, which strips out food and energy, rose 0.4% month on month. The market expected 0.3. That single extra tenth of a percent set off a chain reaction across every market. Look at what actually drove the number higher. Electricity rose 2.1% in a single month directly connected to oil prices. Food rose 0.5%. Beef jumped 2.7% month on month. Tomato prices soared 15% for the second month running, blamed on drought conditions across North America. This is not just oil inflation anymore. It is spreading into food, utilities, and everyday household costs. Here is the statement that shocked markets most. The chief investment officer at Northlight Asset Management told CNBC it is possible we may start pricing in rate hikes for next year. Not cuts, hikes. The conversation has shifted from when will the Fed cut to whether the Fed might actually need to raise rates again. If that repricing takes hold broadly, every growth stock and AI name faces a significant valuation headwind. The Iran war is now visibly inside the inflation data. Brent crude settled above $107 yesterday. The Strait of Hormuz remains effectively closed. Iran's latest counterproposal now demands not just sanctions relief, but war reparations. The gap between the two sides is widening, not narrowing, going into the Trump-Xi summit. The chip sector had its worst day in months. Qualcomm plummeted 13%, its worst single session since 2020. Intel fell 8%. On semiconductor, dropped over 6. Skyworks down 6. The iShares Semiconductor ETF sank 5%. This is particularly jarring because just last week, the same sector was at all-time highs on AMD and ARM earnings. The hot CPI print flipped the entire trade in a single session. Here's the mechanism. Hot CPI pushes. Treasury yields higher, the 10-year jumped to 4.47% yesterday. Higher yields mean future earnings are discounted more heavily in today's money. Chip and AI stocks, which are valued on earnings years into the future, are the most mathematically sensitive to that discount rate. When yields jump, chip stocks fall disproportionately hard. This is not irrational. It is textbook valuation math. The volatility here is extraordinary. 2 weeks ago, AMD gained 19% on AI demand. ARM holdings gained 22%. The semiconductor ETF gained 5% in a week. Yesterday, the same sector lost 5% in a single session. This is what a macro-driven market looks like, where a single inflation number can reverse weeks of fundamental earnings momentum in one day. The full market closed for yesterday. S&P 500 down 0.81%. NASDAQ down 1.94%. Russell 2000 down 2.34%. Small caps hit hardest because they are most sensitive to rate expectations. The 10-year yield rose to 4.47. Oil settled above 107. Gold fell nearly 1%, despite the inflation data which tells you investors were selling everything for cash, not rotating to safe havens. Here is something that should intrigue every investor. Gold fell nearly 1% yesterday on a day when inflation came in hotter than expected. In normal markets, hot inflation is the strongest possible argument for buying gold. Gold is down 10.7% from pre-war levels. Silver is off 14.4%. Precious metals have completely failed to fulfill their traditional safe haven role in this war. The reason war-induced inflation has frozen central banks, which is pressuring all assets simultaneously, including gold. A significant milestone yesterday. The Senate voted 51-45 to confirm Kevin Warsh to the Federal Reserve Board of Governors, a mostly party line vote with only Democratic Senator John Fetterman crossing lines to support him. The vote to confirm him as chair is expected today. Jerome Powell's term ends Friday. The Fed transition is happening in real time, in the middle of the most consequential inflation data in years. WARSH is seen as more open to rate cuts than Powell and markets initially liked that. But the critical reality is that the CPI data now makes any cut in 2026 virtually impossible, regardless of who chairs the Fed. Goldman Sachs and Bank of America both confirm no cuts until 2027 at the earliest. The new chair changes the tone, the inflation data changes the timeline. Now, the story of the week that has nothing to do with inflation and everything to do with ambition. GameStop CEO Ryan Cohen offered to buy eBay for $56 billion. GameStop is worth $10.3 billion. They tried to buy something 5 times their own size. eBay responded with a letter saying the bid was, and I am quoting directly, neither credible nor attractive. It was a polite corporate rejection of what many called the most audacious deal attempt of the year. Here is why analysts called it incredible in the literal sense. The offer was half cash, half GameStop stock totaling $56 billion. GameStop has approximately $4 billion in cash on its balance sheet. The remaining $28 billion in cash would need to come from fresh borrowings. Cohen said he has secured financing commitments, but he is asking lenders to fund a company with declining revenue to borrow more than 6 times its market cap to buy a much larger business. Fortune magazine compared the deal structure to AOL-Time Warner, one of the worst acquisitions in business history. The AOL-Time Warner parallel is worth understanding because it reveals a pattern. In January 2000, AOL, an internet company with an inflated stock price, bought Time Warner for $350 billion using its overvalued shares as currency. The deal destroyed hundreds of billions in value. GameStop is using the same playbook, using a meme-elevated stock as currency to acquire a real business. The difference is, eBay rejected it immediately. AOL's deal actually closed. There is a detail in this story that most people missed. Starting February 4th, GameStop quietly accumulated a 5% stake in eBay before making any public announcement. That secret buying likely contributed to eBay's stock rising to near all-time highs. Then on May 1st, Cohen announced the bid at $125 per share. eBay has now rejected it. GameStop still holds that 5% stake. The question of what they do with it next is unresolved. Trump is flying to China today for the summit with Xi and the delegation accompanying him. Reads like a who's who of American business. Tim Cook of Apple, Elon Musk of Tesla, Larry Fink of BlackRock, Kelly Ortberg of Boeing, David Solomon of Goldman Sachs. When the CEOs of Apple, Tesla, BlackRock, Boeing, and Goldman Sachs all fly to Beijing together. This is not a diplomatic formality. This is a business negotiation at the highest possible level. 5 topics are on the table at this summit. AI guardrails, both countries trying to set rules for AI development competition. Rare earth exports, China controls over 60% of global supply. Semiconductor access, the ongoing chip export restriction debate. Trade tariffs, which have reshaped supply chains for 2 years. And Iran mediation. China has been quietly urging Iran to accept a diplomatic solution. Any breakthrough on any of these 5 topics can move specific sectors sharply. Rare earths deserve special attention from investors because they are the hidden vulnerability in every technology supply chain. China controls over 60% of global rare earth production. These minerals go into every semiconductor, every electric vehicle battery, every defense system, every smartphone. If the Trump-Xi summit produces a rare earth agreement, companies like Apple, Tesla, and every chip maker benefit immediately. Tim Cook's presence on this trip matters specifically for Apple investors. China accounts for approximately 17% of Apple's total revenue. Over 90% of iPhones are still manufactured in China. The Intel chip deal represents Apple beginning to diversify, but that takes years. For now, Cook is in Beijing because Apple's supply chain and its biggest growth market outside the US both depend on what is agreed at this table. The market is treating the Trump-Xi summit as a trade and technology negotiation. but China has been quietly urging Iran to accept a diplomatic solution ahead of this summit. If Trump uses the Beijing meeting to ask China to use its significant influence over Iran to help close the Hormuz deal and both deals happen, simultaneously, oil falls, inflation eases, the Fed can cut, and tech supply chains stabilize. That is the biggest potential bull market catalyst of the entire year. Not everything fell yesterday. Vestas, a uniform and apparel maker most investors have never heard of, surged over 30% after its fiscal second quarter results beat expectations. This is a business-to-business company that supplies uniforms to hospitals, hotels, and factories. While consumer spending is softening under inflation pressure, business-to-business spending on essential supplies remains resilient. Vestas is a signal that corporate operational spending has not broken. Here is a number from last week that deserves attention. The Roundhill Memory ETF, ticker DRAM, gained nearly 30% in a single week. This ETF holds Micron, SK Hynix, and Samsung, the three companies that make high-bandwidth memory chips for AI accelerators. 30% in 1 week is an extraordinary move for a diversified ETF. It tells you that institutional money is moving into AI memory, specifically as a high-conviction bet. Tonight, Cisco reports earnings after the bell. Cisco makes the networking equipment that connects everything inside every AI data center. Every time Google, Microsoft, or Amazon builds a new AI facility, Cisco sells them the networking infrastructure. If Cisco's AI infrastructure orders are growing, it confirms the data center build-out is continuing despite the macro pressure. Alibaba also reports this week, with options pricing a 5.9% move. After the Trump-Xi summit results, Alibaba's AI cloud commentary will tell you whether Chinese tech is accelerating alongside US AI, or whether US export restrictions have created a measurable gap in capability. That gap has direct implications for the NVIDIA China H200 trade we covered last week. Applied Materials reports Thursday, and this is the most forward-looking report of the entire week. Applied Materials sells the equipment that manufactures chips. When chip factories order more equipment, it means they expect higher chip demand 6 to 12 months into the future. Strong AMAT guidance means the semiconductor boom is expected to continue well into 2027. The S&P 500 had 6 consecutive weeks of gains, its longest winning streak since 2024. Yesterday's sell-off is the first real test of that rally. The question every investor is asking right now is whether this is a healthy pullback within an ongoing bull market or the beginning of a more serious reversal driven by stubborn inflation and a rate hike narrative. An investment strategist last week said this market is like the internet on steroids and that we are still in the second or third inning. The critical difference from the late 90s, today's AI companies have real, measurable, accelerating revenue. The late 90s internet companies mostly did not. That distinction matters enormously for how you manage risk in this market. How you respond to yesterday depends entirely on your investment approach. Long-term AI investors, the fundamental thesis has not changed. Alphabet, AMD, Palantir, and Microsoft all reported real AI revenue acceleration. One hot CPI print does not reverse that. Macro traders need to watch yields and oil daily. Conservative investors have every right to raise cash and wait for the data to show a downward trend. Your watch list for the rest of this week. Today and tomorrow, Trump-Xi summit. Tonight, Cisco. Wednesday, producer price index. Thursday, applied materials and retail sales. And circle May 20th, NVIDIA is the most important earnings call of this entire AI investment cycle. 3 scenarios for the rest of May. Scenario A, summit succeeds and Iran deal follows. Oil drops to the 80s, bull market extends powerfully. Scenario B, partial progress, Iran stalemate, selective positioning in AI revenue generators and energy. Scenario C, summit fails. Iran escalates. Oil goes to 115 plus. Rate hike pricing begins. Defensives and cash is the right posture. The single most important number you can watch tomorrow morning is the oil price. Below 90, a deal is being priced as near certain. Between 90 and 110, uncertainty, stay balanced. Above 110, escalation priced in, go defensive. That thermometer tells you everything. Do not let yesterday's macro sell-off obscure what the underlying earnings season is showing. 73% of the S&P 500 has reported. 84% beat estimates. Earnings growth is still tracking at 28% year over year. The tension in this market is between strong fundamentals and a difficult macro environment. Understanding which is driving price action on any given day is the key skill right now. This is the market right now in one image. Hot inflation, oil above 100, no rate cuts. Iran unresolved, chip sector selling off pulling one way. Record earnings, AI revenue confirmed. Supply constrained demand. Yardeni target 8,250. JP Morgan calling the supercycle just getting started, pulling the other. The market will continue oscillating between these two forces until one decisively wins. The May 12th summary in 6 lines. Hot CPI bearish. Qualcomm minus 13 bearish. Chip sector minus 5 bearish. WARSH confirmed neutral. GameStop rejected by eBay, fascinating. Trump departs for Beijing, pivotal. 3 bearish data points, 2 wildcards, and 1 event that could override all the others. Drop a comment what matters most to you this week: the Trump-Xi summit result, Nvidia earnings May 20th, an Iran deal breakthrough, or the next CPI print in June. Tell me which one you are watching most closely. I read every comment. I am Marcus. The Trump-Xi summit results come in today, and tomorrow I will be back with the full breakdown as soon as they land. Subscribe and hit the notification bell so you do not miss it. Nvidia reports in 7 days. I will see you in the next one.